In this video, traders, we have a quick guide to futures versus CFDs. Stay tuned. Hey guys, warm welcome to you. If you're brand new here, welcome. Consider subscribing for more videos about futures, CFDs, trading setups, trading strategies, mindset, anything to do with trading. If you love trading, this is the place to be. And if you are a long-time subscriber, I appreciate your support. I know you guys are commenting, sharing, liking, subscribing, all that good stuff, and it's much appreciated. Right, so let's get down to it. So futures versus CFDs. Very, very similar, but some little nuances that might make you decide to trade one or the other. Okay, so a CFD, very, very briefly, contract for difference. It's a contract between you and another party to pay the difference in the asset value. So if you're long, you're expecting the asset to go up, then the counterparty will pay you if it goes up, you will pay him if it goes down, and if you're short, it's vice versa. So it's purely a contract, it's purely a speculation on the direction of an underlying asset. We can trade CFDs in many different things, but for example, we've got FTSE 100, DAX, which is the German 30, Dow, Nasdaq, gold, oil, natural gas, silver, it list goes on and on and on. And these all have futures contracts as well, so we'll get to that in a moment. So you've got these options. Now, CFDs are really you're trading against a counterparty. So there's no general centralized exchange, unlike a futures contract, which have a centralized exchange like NYMEX, like Eurex, any of these kind of things. Whereas a CFD, you're trading literally against another broker, and that broker is giving you the contract. There's no central exchange for them. Now, they may hedge that in the underlying market. That's something separate, but forget about that for now. Okay, so one of the major differences is the expiry. Now, I'm generalizing here with most CFDs. Now, some CFDs with all this kind of stuff is some brokers offer different kind of options and new products all the time, but generally speaking, these facts kind of ring true. So the expiry, there's no expiry with the CFD. Very simply, you just decide the asset you want to trade and decide whether you're going to go long or short. So if you think that crude oil is going to go up over the next 2 weeks, you can buy a CFD and hold that for 2 weeks very simply, and the position size we'll talk about in a moment will determine and the direction it goes will determine your profit. Now, a futures contract has an expiry, so you have to decide which one you want to trade. You may well want to trade the front month, which is the one nearest to expiry. For example, that could be December crude oil, and in theory what happens is, in reality, it doesn't happen for speculators, but really what happens is if you buy one contract of crude oil for, let's say, December expiry, December 22nd expiry, when it gets to December the 22nd, you will have to pay the full value of the contract. You have to put a margin at the beginning. You have to pay the full value of the contract, i.e. the full value of that crude oil contract, which is 1,000 barrels times the price that you paid. And in return, you will receive 1,000 barrels of crude oil. So it's designed for speculators. It's designed for people who are consuming or producing crude oil or whatever it may be. Now, as a speculator, you won't want to do that. So what you do is you would roll your contract. So as it gets to expiry, you start to roll it to the next month. Some futures contracts are every 3 months, some are every month. You need to work out what that is. So it's a little bit simpler trading with CFDs. You literally go back to the raw thing of which direction do I think this is going to go and how much am I prepared to risk. You have to worry about trading the correct contract size, etc. Another thing about contract size, guys, while we're there, the futures contract is a fixed contract size, and that can be quite high actually. For stuff like DAX and oil, it's super high, and silver as well, super high, relatively speaking. So what that means is you're going to have to, you get quite a lot of, you're risking quite a lot. So maybe if you've got a smaller account, or maybe if you like to have multiple positions, that might not be suitable. For example, crude oil, one contract is $10 per cent move. So, if it's a $50 and 10 cents and goes to $50.20, that's $100. Now, that's a very small move. And if you've got multiple positions, that might be too much for you. And you can't go any smaller than that because that's the minimum contract size. One contract is that. Now, if you looked at, say, CFD, very often many of the brokers don't have that larger contract size. Some do, but most don't. Most will say, hey, one contract is $1 move. So in other words, if it goes from 10 to 20, if you're trading the futures contract, $100. If you're trading the CFD and you have one CFD, it might be $10. Now, these numbers might be small, but if you can imagine if crude oil was going to move $1 in a day, you might not want to be swinging around $1,000 a day on your position. Or if you do, the other thing is you might want the granularity of being able to scale in and out of position. if you want to hold, say, be able to scale in a position, you've got to have at least 2 contracts. All of a sudden, if it's moving a couple of dollars a day, $4,000 move, that's quite a lot, depending on your account size, of course. Whereas a CFD, you can trade a few, but you're still being able to peel some off, and you have lots of kind of opportunity to scale in and out because they've got multiple positions. So that's something to consider as well if you're trading a CFD. The other thing is, sometimes you have after hours markets on CFDs. Futures are very strict with the exchange hours. Of course, the exchange shuts at a certain time, reopens again. I'd say most CFD providers do match the underlying exchange hours, but some will offer a kind of grey market, if you like, spread a bit wider, but you're allowed to get out of the position when the underlying is closed. So one advantage to look out for. The other thing is the CFD is that we're tracking an underlying market. And with a futures contract, the time to expiry changes price. So what does I mean by that? So in other words, the CFD literally will be a fixed price tracking the underlying market. So if you're trading, the DAX, whatever the DAX cash may be, it will be adjusted for that, but it won't effectively change like the futures contract does in price. After the futures contract rolls over to the next month, then the price is basically made up of the underlying plus the component of the time to expiry, because it has to allow for the kind of interest or the risk-free rate of return, if you like. It's quite a complicated formula, but ultimately it can become a little bit confusing how the price changes, especially if you're charting. Whereas if you're charting with a CFD, it's a very flat, simple way of doing it, especially if you've got an underlying cash, which is kind of adjusted for the index. It's not the underlying cash, but it's slightly adjusted. But it helps when you're charting, you're looking back over a long period of time. You haven't got this futures contract, which is constantly adjusting. Now, some charting platforms do allow for that, but it just simplifies things off a little bit. We've got the margin requirements. CFD margin requirements, although ESMA rules have dictated to change in this, ultimately it's up to the CFD provider to decide on the margin requirements that they're prepared to offer. Changes for retail versus professional, changes depending on which broker you want to do. It's up to them and a commercial decision. But whereas if you went to the exchange sets the margin requirements. It's just, that's the way it is. If you want to hold a position overnight, you have to meet those exchange margin requirements. Bear in mind, guys, some brokers do have a day trading margin requirement, and that's them taking the risk on. But ultimately, if you want to hold anything overnight, you've still got to stump up the full exchange margin for that product and that instrument. CFD is slightly different, so that can be a bonus. You might be able to use much more, or put your money to much better use, if you like. And the final thing is cost to trade can be lower on a CFD. So let me explain why. So futures contract, you've got your spread, obviously. You've got your exchange fees, you've got your commissions, clearing. There's little fees in there that are bundled together. Some people have a bundled price, some people have unbundled. But ultimately, that's the way it is. Now, CFDs, because very often, guys, there's so much liquidity out there, and because you're trading against the broker and they're kind of mixing all of the orders together, they can actually offer it at a very reasonable price. Now, depending on who you're trading with, depending on the broker, the CFD may well be a spread plus a commission, or it may just be wrapped into the spread. Again, it doesn't matter, you're still paying the same kind of thing, but it's just a different way of doing it. But very often, you might be trading something that's actually cheaper to trade via a CFD than it is to trade via a futures contract, by the time you've taken into account the spread they're offering and the commission. So that's worth looking. If you're very active in a market, for example, let's say the DAX or the FTSE 100 or one of these frequently traded markets, very popular, you might find out that it's cheaper in terms of transaction costs to use a CFD than it is to trade directly on the futures exchange. Plus you get the benefits of being able to trade in a smaller size. The DAX contract, for example, 25 euros per, it's a lot. 25 euros per tick move is a lot. If you're trading, multiple positions, it might be fine for you if you just trading that exclusively, a couple of contracts, whatever, and you're a bit more advanced trader. But for a newer trader, to put that sort of risk on is really too much for most traders. So CFD opens up some markets as well that you might not otherwise get access to. Silver, another big contract size. Again, you could trade that via CFD, small contract size, get used to it, get your models right. Or if you want to scale up, then you've got the option to kind of scale up and down dynamically the position size. So those are some differences, guys, between CFDs and futures. Sure, there's a few more out there, but these are the ones that I've picked out for now. And take care. See you in the next one. Keep the risk managed, whatever you're trading. Bye-bye.